The fear nobody is talking about. Honestly, there is something happening right now in the global financial system that most people sense but cannot quite name. You feel it when you go to buy groceries and the total is higher than last month. You feel it when you fill your gas tank and something inside you quietly says, "This does not add up." You feel it when you look at your savings account and realize that the number might be the same, but what that number can actually buy you has quietly shrunk. That feeling has a name. And today, Kevin Price is going to talk to you honestly about it. My name is Kevin Price, and I want to start this conversation not with charts, not with numbers, and not with predictions. I want to start with a moment from my own life that changed the way I think about money forever. Years ago, I was sitting across the table from a man who had spent 40 years building what he believed was a secure retirement. He had done everything right, or at least everything he had been told was right. He had saved in a traditional savings account. He had kept cash. He had trusted the system. And when we sat down together to look at the real purchasing power of everything he had accumulated, the look on his face was not anger. It was quiet devastation, because the number in his account had grown. But the life that number was supposed to buy had moved out of reach. That moment stayed with me, and it is the reason I am here with you today. The title of this video asks a powerful question. Dollar collapse fear, gold, silver, and crypto. Set to boom, there is a reason that question is being asked more loudly right now than it has been in decades. And before we get into gold, silver, or cryptocurrency, before we talk about what might boom or what might fall, we have to understand the foundation of the fear itself. Because if you do not understand the fear clearly, you will react to it emotionally. And emotional reactions to financial fear almost always result in poor decisions. So let us begin with the dollar, not as a political statement, not as a conspiracy theory, but as a financial instrument that has a very real and very documented history. The United States dollar has been the world's reserve currency since the Bretton Woods Agreement after World War II. What that means, in simple terms, is that most of the world's trade, most commodities, most international debts are priced and settled in dollars. This gave the United States enormous power. When you control the currency that the world depends on, you have the ability to print more of it without immediately feeling the consequences that other countries would feel. But here is what every student of financial history understands. That power is not infinite, and the mechanism that has allowed the dollar to maintain its dominance for decades is slowly, quietly, and very visibly being tested. Let me explain this in a way that makes sense without requiring you to have a degree in economics. Imagine you are running a business. And for years, everyone in your neighborhood agrees to only use your tokens to buy and sell things. Because your tokens are universally accepted, you can print a few extra whenever you need to cover your expenses. People still trust your tokens because they trust you and because there is no better alternative. Now imagine that some of your neighbors start quietly trading with each other using a different token, and then more neighbors join them. Slowly, the demand for your token begins to fall. And as demand falls, the extra tokens you printed start to show up as inflation, as rising prices, as a quiet erosion of what each token can buy. This is not a hypothetical story. This is, in broad strokes, what is happening with the global monetary system right now. Multiple nations are actively working to reduce their dependence on the dollar. Trade agreements are being structured in local currencies. Central banks around the world are buying gold at rates not seen in 50 years. And ordinary people, investors, families, retirees, they are asking the same question you are asking today. If the dollar weakens, if the system I have always trusted starts to crack, what do I do? Now I want to be very careful here, because this is the exact moment where bad financial advice enters the room. When fear is in the air, when uncertainty is real, there are always voices ready to take advantage of that fear. They will tell you the dollar is about to collapse tomorrow. They will tell you to sell everything and buy gold immediately. They will promise you that some cryptocurrency will make you rich overnight. And those voices are dangerous. Not because the underlying concerns are false, but because the urgency they create pushes people to make decisions that are not rooted in understanding. They are rooted in panic. Kevin Price is not here to panic you. I am here to educate you. And education begins with this truth. The dollar is not collapsing overnight, but its long-term purchasing power is under real and documented pressure. And the assets that have historically protected people during periods of currency weakness, gold, silver, and increasingly certain digital assets, deserve serious, calm, and intelligent attention. Let us talk about what dollar weakness actually looks like in practical terms. It does not look like you waking up one morning and your dollars being worthless. That is a movie version of currency collapse. The real version is slower, more insidious, and far more damaging in the long run precisely because people do not see it happening in real time. Real dollar weakness looks like this. 10 years ago, a family could live comfortably on a certain income. Today, that same income, even adjusted for raises, feels tight. Not because the family is spending recklessly, but because each dollar they earn buys less than it used to. The price of housing has risen dramatically. The cost of healthcare continues to climb. Education, food, energy, all of these essential categories have seen prices rise at rates that outpace what the official inflation numbers often reflect. And here is the part that most financial conversations skip over. When people feel this pressure, when they sense that something is wrong with the money system, they do not always articulate it as dollar weakness or monetary policy. They articulate it as stress, as worry, as a vague sense that no matter how hard they work, they cannot seem to get ahead. That feeling is not irrational. It is a reasonable response to a real phenomenon. So what is the lesson of part 1? It is this. The first step to protecting your financial future is not to rush out and buy anything. The first step is to understand what is actually happening and why. Fear without understanding leads to poor decisions, but understanding transforms fear into strategy. And strategy, not panic, is what builds lasting financial security. The concern about dollar weakness is real. The historical record shows that no fiat currency, meaning no currency backed only by government promise rather than a physical asset, has maintained its value indefinitely. Every fiat currency in history has eventually experienced significant devaluation. The dollar, for all its strength and dominance, is a fiat currency. Understanding that is not pessimism. It is financial literacy. And once you understand that, you can begin to look at gold, silver, and even cryptocurrency not as get-rich-quick instruments, but as potential tools for long-term wealth preservation. That is the conversation we are building toward, but we are not rushing there. Because the investors who rush are usually the ones who get burned. We are going to take this step by step. We are going to look at each asset class clearly and honestly. We are going to talk about the mistakes people make when fear drives their decisions. And we are going to build a framework that you can carry with you regardless of what the markets do next week, next month, or next year. Because the goal is not to predict the future perfectly. The goal is to position yourself wisely for multiple possible futures. That is what real financial intelligence looks like. Part 1 has given you the foundation. You now understand the nature of the fear, where it comes from, and why it is not irrational even if the loudest voices around it often are. You understand that the dollar is under pressure, not because of conspiracy, but because of the documented mechanics of monetary history. And you understand that the appropriate response to that knowledge is not panic, but preparation. In part 2, we are going to go deep into gold and silver. We are going to look at their actual historical role as stores of value, the mistakes people make when buying them, and what a truly intelligent long-term position in precious metals looks like. We are going to separate the sales pitch from the substance, and we are going to be honest about both the strengths and the limitations of these ancient stores of wealth. This is a conversation that could genuinely change how you think about your money, your future, and the decisions you make with the resources you have worked so hard to build. Gold and silver, ancient shields or outdated tools. For thousands of years, before banks existed, before stock markets were invented, before anyone had ever heard the word cryptocurrency, Human beings stored their wealth in two things, gold and silver, and there is a reason those two metals survived every empire, every war, every currency crisis in recorded history. They are not just shiny, they are scarce. They cannot be printed, and they cannot be created out of thin air by a government decision. When a currency weakens, gold tends to strengthen. This is not a theory. This is a pattern that has repeated itself across centuries and across continents. When the Roman Empire debased its currency by mixing cheaper metals into its coins, gold held its value. When the Weimar Republic in Germany printed money so aggressively that people needed wheelbarrows of cash to buy bread, those who held gold survived with their wealth largely intact. When the dollar weakened significantly in the 1970s following the end of the gold standard, gold prices rose dramatically over that decade. These are not coincidences. They are the market's natural response to currency weakness. But here is where I want to be honest with you, because honesty is more valuable than excitement. Gold and silver are not perfect investments. They do not pay dividends. They do not generate income. If you lock your money into gold and the economy remains stable and the dollar remains strong for 10 years, you may look back and feel you missed growth opportunities elsewhere. Gold is not a wealth-building machine. It is a wealth preservation tool, and understanding that distinction is everything. The mistake most people make when they first discover the case for gold is that they treat it like a lottery ticket. They hear that the dollar is in trouble. They rush out and buy gold at peak fear prices, and then when the market stabilizes temporarily and gold pulls back, they panic and sell at a loss. They bought with emotion and sold with emotion and ended up worse than when they started. The intelligent approach to gold and silver is different. It is not about timing the market. It is about using these metals as a consistent, long-term anchor in a diversified portfolio. Financial thinkers who have studied currency history often suggest that holding somewhere between 5 and 15% of your investable assets in physical precious metals provides a meaningful hedge without overexposing you to their limitations. Silver deserves its own moment here because it is often overshadowed by gold, but carries its own compelling case. Silver is both a monetary metal and an industrial one. It is used in solar panels, in electronics, in medical equipment. So it carries dual demand. When economies are growing, industrial demand pushes silver up. When economies are contracting and currencies are weakening, monetary demand pushes silver up. That dual nature makes it uniquely interesting, though also more volatile than gold. The core lesson of Part 2 is this. Gold and silver are not relics of the past. They are time-tested instruments of financial survival, but they reward patience and discipline, not panic and speculation. If you approach them with a long-term preservation mindset, they can play a genuinely powerful role in protecting what you have built. Cryptocurrency, revolution, risk, or both? Let us talk about the most misunderstood asset class of our generation, cryptocurrency. And I want to start by saying something that might surprise you. The people who hate crypto blindly and the people who love crypto blindly are both making the same mistake. They are letting emotion replace analysis. And in finance, that always costs you. Here is what cryptocurrency actually represents at its core. It is an attempt to create a form of money that no government can print, no central bank can manipulate, and no single authority can control. Whether you believe that attempt will ultimately succeed or fail, the idea itself is a direct response to the exact problem we discussed in Part 1, the weakness of government-issued currency. Bitcoin, the first and still the most significant cryptocurrency, was created in the aftermath of the 2008 financial crisis. That timing was not accidental. Its creator designed it with a fixed supply. There will only ever be 21 million Bitcoin in existence. Ever. Compare that to the dollar, where trillions can be added to the supply through a policy decision. That scarcity is not a marketing feature. It is the entire philosophical foundation of the asset. Now, here is where I have to be direct with you about the risks, because cryptocurrency is also genuinely, significantly volatile. We have seen major cryptocurrencies lose 70, 80, even 90% of their value within a single year. People who invested money they could not afford to lose. People who borrowed to buy crypto. People who put their entire savings into a single digital coin because someone online told them it would make them rich. Many of those people experienced devastating losses. That is not a reason to dismiss the entire asset class, but it is an absolutely critical reason to approach it with discipline. The intelligent framework for cryptocurrency in a long-term portfolio looks something like this. Only allocate what you can genuinely afford to have go to zero. Treat it as the highest risk, highest potential portion of a broader diversified strategy. Focus on assets with the longest track record and the most established infrastructure rather than chasing newer coins promising extraordinary returns. And do not check the price every hour. Volatility rewards patience and destroys anxiety-driven traders. The connection between crypto and dollar weakness is real and logical. As more people lose confidence in government-managed currencies, the appeal of a mathematically limited, decentralized alternative grows. That does not mean crypto replaces the dollar tomorrow, but it does mean that in a world of increasing monetary uncertainty, digital assets with genuine scarcity have a logical place in the conversation about wealth preservation. The lesson of Part 3 is this: cryptocurrency is not magic, and it is not a scam. It is a young, volatile, genuinely innovative asset class that carries real risk and real potential. Respect both equally. Never let the excitement of potential gains cause you to risk more than you can afford to lose. And always remember that in a diversified long-term strategy, the goal is survival first and growth second. The biggest mistakes people make when fear drives their financial decisions. Everything we have discussed so far, the dollar pressure, gold, silver, cryptocurrency, all of it becomes dangerous in the hands of fear. And I say that not to discourage you, but to protect you. Because the single greatest threat to your financial future is not a collapsing dollar. It is not a crashing market. It is not even a failed investment. The single greatest threat is a version of yourself that makes decisions under emotional pressure without a clear framework. Let me walk you through the most common and most costly mistakes that ordinary people make when financial fear takes over. The first mistake is called all-or-nothing thinking. This is when someone hears a compelling argument about dollar weakness and immediately decides to convert everything they own into gold or crypto. They abandon balance entirely. They go from one extreme to another. And what almost always happens is that the market does not move in the clean, dramatic direction they expected on the timeline they imagined. They grow impatient or frightened, and they exit at the worst possible moment. Diversification is not a compromise. It is armor. The second mistake is following the loudest voice in the room. When fear is in the air, charismatic voices with confident predictions attract enormous audiences. And the louder and more certain someone sounds, the more people trust them. But financial markets have humbled every person who claimed to know exactly what was coming next. The voices you should trust most are the ones who acknowledge uncertainty while still providing a rational framework for navigating it. Certainty in finance is almost always a sales tactic. The third mistake is mistaking activity for strategy. When people feel financially anxious, they feel the need to do something, to move money, to buy something, to sell something. The action itself feels like control. But undisciplined action in financial markets is often more destructive than patient inaction. Some of the greatest wealth in history has been built simply by buying quality assets and holding them through turbulence without flinching. Doing nothing intelligently is still doing something. The fourth mistake is ignoring your own financial foundation while chasing protection from macro fears. I have spoken with people who were genuinely worried about dollar collapse while simultaneously carrying high-interest debt, having no emergency fund, and owning no meaningful assets at all. If your financial house is not in order, no amount of gold or crypto will save you. Before you think about hedging against currency risk, make sure your immediate financial foundation is solid. Clear high-interest debt. Build an emergency reserve. Then think about long-term positioning. The fifth and perhaps most painful mistake is letting fear of loss prevent any action at all. This is the opposite extreme. Some people become so overwhelmed by the complexity and the risk of financial decisions that they do nothing. They leave everything in cash. They tell themselves they will figure it out later, and later becomes years, and years become decades. And the quiet erosion of purchasing power does its work silently, while they wait for perfect clarity that never arrives. Imperfect action guided by sound principles is always better than paralysis. The lesson of Part 4 is the one that ties everything together. Your financial decisions are only as strong as the emotional and intellectual framework behind them. Understanding the risks of dollar weakness is valuable. Knowing about gold, silver, and crypto is valuable. But none of that knowledge protects you if fear is still driving the car. Build your framework first. Understand your goals, your timeline, your risk tolerance, and your current financial position. Then make decisions from that place of clarity rather than from the noise of the moment. You are closer than you think to having a genuinely sound long-term financial strategy. The final part brings everything together with a clear warning and a takeaway you can carry with you permanently. The final warning and the strategy that actually works. We have covered a lot of ground together in this conversation. We talked about why the dollar is under real and documented pressure. We talked about gold and silver as time-tested preservation tools. We talked about cryptocurrency as a young but legitimate asset class that demands discipline. We talked about the emotional mistakes that destroy financial futures even when the underlying knowledge is sound. Now I want to bring everything to a close with the honest, clear, final message that this entire conversation has been building toward. Here is the warning. And please listen to this carefully because it is the most important thing Kevin Price will say to you today. The greatest danger in a moment of financial uncertainty is not the uncertainty itself. It is the industry that profits from your fear. Right now, as concerns about dollar weakness grow, as more people search for answers about gold and crypto and what to do with their savings, there are businesses, influencers, and platforms positioned to take advantage of that anxiety. They will sell you overpriced gold coins with enormous markups. They will promote obscure cryptocurrencies that benefit their own portfolios. They will create urgency where patience is actually what is needed. They will make you feel that if you do not act right now, today, this moment, you will miss everything. Do not let them win. The truth is that genuine wealth protection is never built in a single panicked afternoon. It is built through consistent, informed, disciplined decisions made over years. The people who navigated the 2008 financial crisis successfully were not the ones who made the most dramatic moves at the peak of the fear. They were the ones who had already built diversified, fundamentally sound portfolios and had the discipline to hold through the storm. That is the model. That is the standard, and it is available to you regardless of how much or how little you currently have to invest. So what does a sound long-term strategy actually look like given everything we have discussed? It starts with your foundation. No debt with punishing interest rates. A genuine emergency fund that covers 3 to 6 months of your essential expenses. Without that foundation, everything else is built on sand. From that foundation, you build a diversified portfolio that reflects your personal timeline and risk tolerance. A meaningful portion in stable long-term assets. A smaller but deliberate allocation to precious metals as a hedge against currency weakness. And if your risk tolerance genuinely allows it, a carefully limited position in established digital assets, never more than you can afford to lose completely. And then you practice the hardest discipline in all of personal finance. You hold. You do not watch the daily price movements. You do not react to headlines. You do not abandon your strategy every time a confident voice on the internet tells you that everything is about to change. You trust the framework you built from knowledge rather than fear, and you give it time to work. Because here is the final truth. Time is the most powerful financial instrument that exists. Not gold, not Bitcoin, not any single asset class. Time, combined with discipline and sound strategy, is what actually builds and preserves wealth across a lifetime. The dollar may weaken further. Gold may rise. Crypto may surprise everyone. Or the timeline may be longer and more complicated than any of us expect. What matters is not predicting which of those outcomes happens first. What matters is that you are positioned thoughtfully and patiently for multiple possible futures. That is financial intelligence. That is what separates the people who look back on turbulent times as opportunities from the people who look back on them as disasters. Not luck, not perfect timing, preparation, patience, and the refusal to let fear make decisions on their behalf. You came to this video with a question: dollar collapse fear, gold, silver, and crypto. Is a boom coming? And the honest answer is that the conditions that have historically driven those assets higher are genuinely present today. But the more important answer is this: whether a boom comes or not, whether it comes next year or in 5 years, the investor who builds a sound, disciplined, diversified strategy today is the one who will be ready. And being ready is always more powerful than being reactive. Thank you for spending this time with Kevin Price. This conversation was not about predictions. It was about preparation. And preparation, done right, is the most powerful financial decision you will ever make. If this video gave you clarity, if it shifted something in the way you think about your money and your future, then please take 1 second right now and hit the like button. It helps more people find this conversation when they need it most. Subscribe to this channel and press the bell icon so you never miss a video like this one. And most importantly, leave your question or your thoughts in the comments below. We read every single comment, and your question may become the topic of our next video. We will answer you there. Your financial future is worth protecting, and you now have the understanding to begin doing exactly that.